Hello, this is Jed Brewer with the Below the Line Club and Study Groups. It's really nice to have you on our webinar today. We're going to talk about two different topics. One is credit department metrics, and the other is using hedging to improve sales. So it should be a really good time of education on both of those topics. Really pleased to have Ann Pitts, who's the founder of the Pitts Group, and she's going to be talking some about credit department metrics and how can we get at the root of problems that we have in creating customer late pay? How do we identify problematic internal systems that we have and other topics as it relates to credit? And then we'll transition to David Thompson, who's the Executive Vice President of Powerhouse. And David's going to talk a little bit about how we can use hedging, as the title says, to improve sales. Not, of course, we want to use it to mitigate risk. But at the same time, hedging gives us an opportunity to grow our business, and David will share some about how marketers are using it for that manner. We want this to be educational, as I said. If you have questions, I encourage you to ask them. I do have you muted, so the way to ask them is to type in the GoToWebinar dialog box. Just type your question in there. I'll be able to read them, and I can relay it to Ann and David at the appropriate time. So quickly on David Thompson, who will be our second presenter. But David is Executive Vice President of Powerhouse, and Powerhouse works with a lot of our study group members to hedge, buy derivatives and financial markets, and set up programs that allow them to mitigate risk. And so that's a bit about Powerhouse. And then Ann is with the Pitts Group, which works with several of our study group members in the credit field, just helping credit departments improve their processes, ultimately collect more quickly, shorten their cash cycle, et cetera. So both are experts in their field. So with that brief introduction, Ann, I'll turn the floor over to you to dive into what we need to know about credit department metrics.
All right. I'm going to get my slide up here as we start, Jed, and thank you for having me for a speaker today. I'm always honored to be able to visit with a group of study group members because you guys are super successful and you're excelling in the industry. There's no doubt about it. As Jed mentioned, I work with petroleum marketers that really want to rethink and refine their own processes and procedures in the credit department. I'm going to use that word during this presentation a few times to rethink, because that's really the challenge I want you guys to have on your mind. So I do work with petroleum company credit offices, and I do it in two ways. One way, I come on site working one-on-one with staff to determine what current processes are, looking at results, and developing a game plan to improve and perfect those processes. And then number two, I host a select group of petroleum credit managers in a monthly Zoom call. We do a little training, we do some group chat about problems, solutions, and share resources. This is not an open call, it is it's a closed group. So I just want to start with just mentioning, I've been going to some meetings lately. We're all starting to move around and getting out a little bit. And a concern that I'm hearing a lot about is, as you guys are growing your companies, and high growth seems to be, you know, David's going to talk about it, but a lot of you are in very high growth situations, but your infrastructure components that are able to support that added on pressure from the growth is a concern. You know, like what's the health of the mothership when it comes to the basic functions that keep gallons going out the door and your customers well taken care of. You have to be able to be proactive about where your weak spots are. And you got to kind of stay in a mode of relative change, which is really hard for most of us. That kind of attitude and openness to change in a company, that you guys might be in a company that's 50 years old, it really has to come from the top down. So I want to talk to you guys about how to keep your eye on your business, things that need to be addressed, taking your clues from the credit department. I think this department can tell you about a lot of strengths and weaknesses in many other areas of your business. So we're going to talk about why these metrics are important. I'm going to share with you some non-financial KPIs that can indicate internal dysfunction, and then I'll give you the most commonly used, more on the financial side, KPIs that petroleum companies use. So, you know, as you guys are aware, the accounts receivable is a huge asset class in your balance sheet. It's one that you have a lot of concern, rightly so, about. You want growth, but you want smart growth. I wanted to do a little math for you just to kind of illustrate what I'm talking about. I talked to a lot of companies about, you know, their accounts receivable aging, and people want to know what's a good percent to be current or to be past due. You know, what's a good benchmark? I'm going to say if you're in the high 80s or low 90s as far as percent, you're doing pretty good. Now, this is not for you retail guys that have nothing but stores. This is for a diversified jobbership, which most of you are. So if you've got like 7.5 million in my example for ABC Petroleum, 7.5 million in accounts receivable, and you're sitting pretty good at 86% of your customers are current, that's still over $1 million that's out of your control. That is your money that is being controlled by your customers. You're not earning any interest for the most part. Some of you might be charging finance, charges, but for the most part, that's just money that you do not have control of. That's a bad situation. Now, before I get started on what I'm going to talk about, I want to give you some rethinking success stories. I really like talking about success stories. So the first one, brand new credit manager, right, brand new in the chair, decides to tackle the project of reconnecting with customers that had either been written off or were in that hopeless to collect category, just hanging out there and hadn't been written off. She called them up cold. She just picked up the phone, introduced herself, said, hey, you owe us this amount of money. Let's team up on a solution to work this out. A lot of customer situation will have changed since the last time someone did this potentially. She was able to collect over $500,000 in old debt. This was someone who was rethinking a situation that had been just accepted as the status quo. So that was a really cool situation. Next one I want to share, brand new credit person, again, starts talking up an easy pay program to customers. That's what they called their electronic pay, their EFT. She didn't know that electronic payments were not something these customers would agree to. She didn't know that no farmer would ever agree to an EFT. All she knew, she was brand new, all she knew is that it was efficient, safe, secure, paperless, easy way to do business. She got the ball rolling on this project, got some other departments involved, customer service, sales guys got behind it, which is where the conversation really needs to start. At the end of a 6-month period, a full 30% of their customer base had signed up for Easy Pay. And these were not dealers, obviously. And guys, electronic payment is your golden ticket to improve cash flow. It's also, thank goodness, becoming more and more accepted by customers. There's really not a better time in the universe than now to transition customers to electronic or Easy Pay. My last success story, credit manager working for a company that had terrific growth. They identified key areas where their old ways of doing things just weren't working well for them. So they put together a team, including upper management, that outlined a project to better utilize specific areas of their back office and truck technology that speeded up their invoicing. So internally, they made the decision to no longer send statements through the mail. That freed up a full half day, 2 times a month for credit staff, and monthly statements were discontinued totally unless a customer opted for an email version. End result, very little customer backlash. The transition went very smoothly. Another good example of rethinking a process. So here's the key. Out of the thousands of processes taking place in your business today, how do you decide what to tackle, what to rethink? I want to suggest to you that you start with something I call measure to repair, using credit department metrics to identify key operational problems, not just financial metrics. So think about your company as a big funnel with sales, or should I say orders. It's really not a sale till it's paid for, right? Orders flowing through the top of that funnel. And the final cycle at the bottom is where you get paid. That's your credit department. So all the other departments involved in this order fulfillment process, from pricing to invoicing to dispatching and on, are going to impact that final act of your customer paying as agreed. And when things go wrong in the funnel, it pools as a no pay problem in the credit department. I think a lot of companies miss out on this particular opportunity to identify internal problems that are showing up in the credit area and on that accounts receivable aging. This is where the problems are coming into roost. So when you can identify why the accounts receivable aging has dollars in those past due buckets, and you can work on getting to the root cause fix, I promise you there are a lot of dollars sitting there because of misfires in your own company's systems and processes. Fixing those are totally within your control, and that is really, really good news because you always want to focus on things that are within your control. So let's take a look at how to identify where those problems are. And a good way to do that is to systematically track some key performance indicators. I know this is not new information to you. You all have your own favorite KPIs, but do you look beyond the KPI to get to the root cause? And do you measure to repair or just measure to do talking in a monthly meeting? Let's talk about measuring to repair. All right, so past due, AR, aging, one of your favorite things to look at. I want to talk about the first bucket, which is your, most of you 10 to 30 day bucket. That's the yellow one. So why are people in here? It's not just people that have missed the first few days of their payment. A lot of times there are invoicing problems. There are pricing problems. Is the correct person receiving the invoice? This is what I call the easy fix bucket. Nobody gets too much heartburn about this bucket. People in this category are at their highest level of quit collecting, and a lot of times your staff gets focused on the collection and they totally miss out on the reason the account went past due to begin with, and they don't get to that root cause fix. So put some emphasis on why people are sitting there and some of the easy ways you can fix that. All right, so let's look at the next one, the second yellow, which is 30 to 60 day bucket. It's definitely worth tracking, but this is a stickier bucket. These are a little more unresolved problems. Probably have had some conversation or two with the client or heard from your customer about it. Some of these guys are having financial problems. Some of them just don't have you very high on their payables list because they don't think it really matters because you're going to supply them anyway. They're not that far past due. There's no late charge to be collected, no incentive to pay. So this bucket needs to be clamped down on with standard collection processes that are swift and relentless in execution. And when somebody makes you a promise, your credit staff needs to really, really follow up the day that promise is broken. And this bucket is where that's really going to be extremely important.
So Ann, I'm curious on that middle bucket that you're talking about. Somebody, they've got the money, you're just not a priority to them. They're kind of stretching you out. What is the tactic to get them to pay more quickly?
You
Add
know,
a late fee? Go ahead.
Well, late fee is great, and I'll tell you this, just throwing it in here, when somebody tells you they don't pay a late fee to a petroleum company, that's when your employee says, I understand that, and we have a perfect program for you. We'll put you on our easy pay. There'll never be any late fees assessed, because we do assess late fees. There'll never be any invoice problems. We give you advance notice of pay, so that's a program for you. That's a good response to that. But you know, you need to be like the electric company. You know, when you miss your electric company bill, you get a letter from them immediately, and it outlines what's going to happen if you don't make a payment by a certain date. So, you know, that needs to happen in that 10 to 30 day category, a dunning letter that's coming out through your back office software. And then, Jed, when they get to that, to your question, to that 30 to 60 day bucket, that's when you need to start the conversation, probably with a phone call. Some guys are really good to give you more information in an email, but an email string goes back and forth and back and forth. Pick the phone up and find out what's going on.
Thank you.
Yeah, so let me just say this, the last bucket, the red guys, the 60 to 90 and then over 90. You know, remember, this is measured to repair. So what's the repair going on in the situation? What's the solid game plan in place with these customers? Your staff ought to know what the story is firmly, what the promise is firmly, or they need to be lined up for a third-party collection effort. That can be owner to owner, that can be an attorney letter, that can be small claims court, that can be collection agency. Third-party collection is very, very powerful for people that are ignoring your efforts to get them to pay. So getting to the root of the problem. All right, moving on. Now we're going to talk about non-financial measurements that indicate internal system efficiencies, breakdowns that you guys have control over. So there's a credit industry statistic. It's not petroleum specific, but it shows that 67% of all past due customers are due to a breakdown in your own system. Those are problems up the funnel that I talked about. So what do you measure here? I want to suggest your favorite credit rebills. What's the situation there? This stuff causes a lot of customer heartburn, not to mention what it costs you with your staff doing research and cleanup. What is the cause of this? Is it your truck technology? Is it something in your back office that can be improved upon? What are your other technological helpers doing, working together, or are they causing some of these breakdowns? So that's one that you can, as a non-financial measurement. Another one is credit holds and releases. And this is going to be a bigger issue as the price of fuel continues to go up, right? People are going to be really bumping up on their credit limits, which triggers credit holds. If you have very few credit holds, you're probably not using the feature, or it's it's not being used correctly. On the other hand, if you have too many in your system, it's in overdrive. And if your credit department is spending a ton of daily time looking at these credit holes and immediately releasing them, that's not fixing the root cause of the problem. That needs to be addressed. Another thing I want to mention in this category is internal credit department calls and inquiries. Why do other staff members call your credit department? And how can those needs be met without an interruptive call or email? Are there other resources available for sales, for example, to see what's going on with credit applications, whether it be through Salesforce.com or some other CRM? I'm not discouraging good communication here, but how can you increase the efficiency? I've literally worked with credit managers that start on their own job duties late in the afternoon because a full half of their day is filled with internal interruptions. And honestly, it doesn't sound very efficient, but the best way to discover this stuff is just have your staff make a tick every time their phone rings and what those calls are centered around. So the last thing I want to talk about on this subject is vastly improving your customer experience. And again, you need to know why your customers are calling the credit department. It is an indicator that things are not working efficiently up the funnel. What are the problems? Why are they having to call you? There is nothing that gives me more, not a good feeling when I have to call somebody I'm trying to buy something from and try to straighten something out. Do you know how much of your staff time and effort is spent performing research and error correction without even getting to the repair of that root cause? So I hope these ideas have given you some good food for thought. I'm going to transition us now to the financial KPIs. These are things that some of these you will know about, others might be new to you, give you some examples of things that would be helpful. Good old favorite DSO. I'm not going to go through the way to figure it. If you guys need more information, if you want to see the detail on this, just email me or call me later. The DSO basically just shows the average time that receivables are outstanding. I want to caution you, if you're a diversified jobbership, you have wholesale business and you have commercial business, your supplier terms are different. So your DSO target is going to be different. If you mix those all together and figure a DSO, it's not going to be that meaningful of a number. And as always, the best people to benchmark against for a beginning is yourself, is your own numbers. Best possible DSO, it is just the best possible level of receivables, and you use that in accordance with the number that you have on your DSO, segmented by business segment.
And it's interesting, Ann, you talk about benchmarking, and benchmarking in yourself, certainly the most useful thing. Just for our study group members, I know your level maybe higher or lower compared to other people in your study group because your business mix is a little bit different, but tracking yourself over time against other people over time can be very informative. If your days of sales outstanding are going up and everybody else is going down, that's a red flag, even if your level is different.
Great point, Jed. Absolutely. All right, back to my list. Average days delinquent, it actually just shows the average time from invoice due date to the pay date. I think that's interesting to know. Percent past due, just about everybody uses this. It's like what percent of our customer base is over 60 days, or between 60 and 90 days, and you track that. You want to do the measurement at the same time each week or month so that your businesses can be cyclical, and you want to make an adjustment for that. So be consistent, track it over a period of time, and you'll get some really good information from that. Collection Effectiveness Index, I don't see a lot of guys using this. I think it's a really good one. It just expresses the effectiveness of collection efforts over time. It's a great tool to use to manage and mentor your collectors. It gives them a good hard look at how effective their processes really are, and they can change the processes if they're not effective enough.
How do you calculate that one?
You know what, Jack? Yeah, I left it off because it's so long. I couldn't get it on here very well. You couldn't be able to read it. So I'd be happy to share with whoever wants it. You could probably Google it. It's a long calculation. It's easy to get to, but the description of it is long.
Yeah.
So let me know if anybody wants that. Bad debt to sales is one you guys, would be worthwhile to keep an eye on also. A low percentage means your effective credit policies and procedures are in good shape. Here's Jed's favorite. He wanted to make sure I had this on here. The cash conversion cycle. This is showing you the company's working capital cycle using your days inventory outstanding, days sales outstanding, and days payable outstanding. Very important metric. So just to wrap up here, I just wanted to share the companies that I've worked with through the last 20 years. DSO, by far the most popular, about 87% from my experience. Percent past due, also very popular, almost 85%. Average days delinquent drops down to about a 31% usage. Best possible DSO, 20, almost 30%. Collective effectiveness, which I think is a really good one, goes down to 26. Other random measurements drops down to a pretty low percentage. So, Jed, that's what I had for you guys. If anybody, needs anything, you can reach me, email or call, and that's pretty much what I've got here, Jed.
Well, thank you, Ann. Question for you. You said early on that moving to prompt pay or easy pay, I can't remember the term you used, but was obviously a way to reduce your receivables, just get rid of the receivable. How do you recommend members go about doing that?
The number one thing they have to do is impress upon their employees the benefits to the customer. Forget benefits to you. Those employees, those diligent sales guys, need to understand how it is beneficial to their customer. I have whole scripts on that topic. And if your employees feel like it's better for the customer, they can sell it. And once they sell it, all they have to do is say, this is how it works. Whatever the objections are, you manage them and say, if you don't like the program after 60 days, you call me and we'll talk about it. You won't get a phone call. It is easier. It is better.
Thank you, Ann. And appreciate you sharing those various metrics too. Certainly those are things that we need to be tracking within our organizations to drive our collection processes and make them more efficient. So appreciate it. And again, for the audience, if any questions come to mind for Ann, please feel free to type them in. We can address them at the close of the webinar. So let's move now to David Thompson. David, I'm going to make you the presenter and allow you to share your screen on ours, but you're going to be talking a little bit how we can use hedging to grow sales within our organization, to change that sales dynamic and be on the same side as your customer. So we look forward to what you have to say, David.
Great, thanks. And is everybody seeing the first slide on the deck here? Is that coming through good for you?
Yeah, it looks good.
Well, I'll skip past the general title here since we know all that. What I want to talk about today is, and I appreciate the chance to be with the study group people, because to echo what Ann was saying, you're growing companies that are looking to find new ways to do better, and you're investing the time in doing that. And that's one of the most key things to growing your business, is making that investment in your own, I'll call it your own knowledge capital, and learning how to develop techniques and skills that you continue using to grow your business and protect your margins. I think a lot of the companies in the study group world understand the basics of hedging and how critical it can be to their bottom line. The difference I wanted to talk about today is looking at two different facets of it. What I would call hedging for both defense and for offense. But one of the important things to understand is that hedging by its very nature is a conservative action. The goal is to protect margins. The goal is to grow your business in an unknowable future. And certainly the last couple of weeks and months have given us a perfect example of just how unknowable the future can be. One of the most common refrains we hear when people are considering hedging, if you're not familiar with it, is that it sounds confusing, it sounds risky, and actually nothing could be further from the truth. We're trying to take risks we want to take, because obviously without any risk, there's not much chance of a reward. So there has to be some risk in your business, but we're trying to minimize them. We're trying to take the risks you want to take, and we're trying to do the best we can to move forward in conditions of uncertainty going, into the future, but still protecting our margins. Perhaps one of the best examples of hedging is the idea of protecting value of something you haven't yet sold. And this is very common when you think about agriculture, crops in the field. Agricultural hedging is probably the basis, certainly in the United States, for where the hedging techniques and strategies were developed first. Seasonal hedging, being able to know the value of the crop you're going to receive, the price you're going to receive for your crop at the end of the year. Another idea, looking at crude oil producers. You're hedging the value of barrels that are still in the ground and aren't going to be produced for years. It's possible to do that to protect your capital structure that way. Or more common to the group we're talking about today is probably protecting barrels of diesel or gasoline or propane that are sitting in your storage tank that you haven't yet sold. You own them, but you haven't yet sold them. So when we think about this hedging for both offense and defense, if you're thinking about protecting those barrels that are still in your possession, I'd call that defensive hedging. And that's something that you're probably most familiar with. It's critical because if you own that product and don't have it sold, any movement down in the market is decreasing the value of that inventory that you own, and therefore eating into your profit margin. And in the days of prices moving slowly, 15, 20 years ago, heating oil prices barely moved a couple cents in the course of a week. As anybody knows, these days it can move that amount in fractions of a minute, and often does. So that's something I think most people are familiar with. What I think is the thing we want to focus on today is this idea of using hedging for what I would call offense, how to drive sales, how to look at ways to solve your customers' problems. And that's really the key to it, because we all talk about the importance of price, and clearly that's a dominant factor when it comes to making sales. What's your price versus someone else? But there's another layer to it, and that's what we want to try and get to today. So when I talk about hedging for offense, what does this mean? I'm going to talk about 4 factors today. There are many, you could look at aspects of them and sort of variations on them, but let's keep them to 4 factors. Motivating customers who are indecisive, competing against competitors, especially larger competitors, finding ways to put yourself on the same side of the table as your customer, and learning how to take what the market is giving you and utilizing that to your advantage. And the critical thing in all this, when you say, okay, but this doesn't sound like hedging to protect my inventory, I'm worried, is this speculation? Very much no. You're working with what your customers are giving you in terms of when your sales teams are out there talking to the customers. If they call them up and they tell them the price and your customers like it and give you an order, that's great. That's wonderful. But the question is, what happens when that is not the answer? What happens when the customer says, well, I'm concerned about what's going to happen going forward. Well, I don't know if this price, man, do you think it's going to go any lower? Any chance it's going to pull back? Oh gosh, it's gone up so much. What do I do now? We hear this time and time again because our company works with a lot of end users. So for the marketers out there, the commercial industrial sales, we know a lot of these people because we work with many of the end users and buyers of fuel directly. And so this is a common refrain. You come across it again and again. What we're trying to do is give you something other than just price to talk to your competitor about, to talk to the customers about. So it's not a speculative idea. It's hedging in under a different guise. And these are what we're trying to come up with are simple tools that you can explain to your customer. Because if it gets too complex, it's not going to end up in a sale anyhow. So we want to try and take what the customer feedback we're getting and use it to our advantage to find a way to solve their problem. And that's going to be a key thing I'm going to come back to several times through this presentation is we're looking to create a different dynamic in your competition out there. You're trying to be different to from your competitors. You're trying to find a way to compete on something other than just price. Because when you can do that, you're now solving a different problem. Obviously, everyone likes getting a low price. But what happens if the market drops after they bought? Then who cares if they were a couple of cents better if we see a big drop in the market? We're now talking about a different layer of the customer's concerns other than just price. And now you're becoming a business partner with them rather than simply just a supplier. You're solving their problems, and that's giving you a different relationship, which is to your advantage. This is a chart of diesel futures based on a weekly price chart, ULSD diesel, and going back 5, 6 years, 7 years, I guess. And as you can see, volatility is a commonplace feature to the market. Starting back all the way in early 2014, we had diesel prices over $3 a gallon wholesale on the NYMEX futures price. We saw drops down to under $1, rallies back up. And remember, each of these little jagged lines in here is probably moves of 10 to 15 cents a gallon. The bigger moves are 40 or 50 cents a gallon. What's one interesting feature, which I was talking with Jed before we started, was I finished my charts before I went on vacation for 2 weeks. I just got back this week. So I left the charts as is when I finished my presentation. So this ends about September 23rd, I believe. And we're going to come back to that. If you notice this price, it was $2.25 a gallon for diesel. We're over $2.50, give or take now. But I wanted to keep that in actually as something that will be illustrative as we're going forward. But the biggest point is volatility is not new to the energy markets. It's a common feature due to seasonality, due to supply issues, due to geopolitics, due to weather, due to economic conditions. People talk a lot about the effects of pandemic, which we can see obviously here in this first quarter of 2020. But heck, there were giant drops in price long before then in 2014 and 15 that were even larger than the drop we saw that came from shutting the global economy for 3 months. So a lot of these ideas, when people say, well, that can't happen, nothing will happen like pandemic again, things have happened like that before. And who can, the point is we can't ever predict the future with certainty. Not saying we don't try and understand what's going to happen, but knowing that we can't, that we won't ever be entirely sure what's going on allows, when we know how to hedge, when we know how to protect our risk, then we can move forward with plans for customers. And the great thing about some of these tactics for hedging for offense is they create win-win situations. And that's something that we'll keep going on a little bit more here as well. Let's talk about one of a very common dynamic that we hear. We work with middle markets companies across the country, and they're often competing with the large marketing arms of the refiners. As we all know, in the fuel world, it's a rather crazy business. Many times you're competing with your own supplier. But the fact is, the middle markets companies have to find ways to be more nimble because the big refiners, if they want to, can always find a way to lower that price and grab some business. So you have to find a way to not compete on price alone. One of these tactics is another first application of finding ways to use hedging to your advantage is let's take a situation where the market's been in a raging uptrend. Sounds familiar, right? But as bullish as the markets have been now, eventually this bull market will end and we will see a correction in price. The same way all bear markets end, all bull markets end. When? That's the million-dollar question, of course. But from our point of view, we have to deal with what's going on in the world. How do we make sales? Let's say it's been a situation where we've been in this very strong rally phase and you lose a deal to a competitor. They find some way to be cheaper and the guy, your customer, buys from them. And then the market tanks 25, 30 cents a gallon. And you'll have a tool in your arsenal that you can come back if you understand about a cap program. What's a cap? A cap is buying a call option or possibly buying a put option if you have a physical supply component as well. But it's using an option. Basically what you're doing is you're saying, I could have come in and given you a price. If you want a fixed price, maybe mine's the best, maybe it's not. But I could also, I'm speaking to you, the marketer, I could also offer you an insurance that you have a cap level. Price, you'll be reimbursed if price goes above. In other words, you won't pay more than a price. But if price collapses for whatever reason and the market moves lower, you can participate in that lower price. You can have a ability to move down with the market if they see a drop during the time period of your contract. That's something that can be very effective, especially, again, I would often counsel for the sales teams of the companies we work with. After a big drop in price, go out and talk to anybody you lost a deal to and say, you know, whoever you bought from, would he have offered you the ability to have a cap instead of a fixed? Meaning the ability to have this lower scale down price if the market drops significantly over the term of your deal. Because when we're talking about a major drop, 20, 30 cents a gallon over the course of a month or 2 months, you know, who cares about being a half a penny or 3/4 cent cheaper at the time you locked in? If you have that ability to have a cap and see a drop in price and have your customer benefit from that, that is a very, very powerful tool. It also, again, gets you away from competing on price alone. And that's something you can work into sales and say, hey, did whoever you bought from last time, did they give you that ability, that cap ability to add in? So you're giving your customer both a fixed idea and a cap idea. So now all of a sudden, you're on the same side of the table as they are. You're not trying to push them into, hey, buy now, we're sure it's only going to go higher from here. And then you have to eat your words if it turns out it doesn't. You can say, I understand, it's scary, it's unknowable, but there's 2 ways to go about this. Let's give you another example of how this can work in an actual sale idea. Let's pick out where here we are right now. We've been in a raging bull market for weeks, if not months. You have a guy you've been talking to, he keeps dawdling, he's not buying, it keeps going up, it keeps going up, and your customer just has that frozen deer in the headlights look. He can't decide, he's petrified that if he buys now, it'll be the top of the market, but you've told him, hey, there's all these reasons the market's strong, and yet he isn't doing anything. And you're worried that, as we've seen, in 2 weeks, we've gone up 25 cents a gallon. And this can start to do real damage to your client and your customer's ability to buy the same amount of fuel or find some way to get what he needs. Here's another way a cap idea can offer your customer some ability to manage his risk. He can have that protection against higher prices, but if the market collapses right after he buys a cap program, there's still the ability to benefit if prices move lower because he didn't lock in, they capped. And then if the prices fall, you can have that ability to offer him a lower price. In other words, it's something that we call it, if you use a golfing term, it's a mulligan on oil prices, a chance to have a do-over. One of our smartest customers created a great phrase for it. He said, buying an option, buying a cap is buying the right to never be wrong about the price of the oil for the term of your deal. Because if prices drop, you can still benefit. You have the protection to keep your fuel costs within a budget, but you have the ability to benefit if something drastic changes in the market. And that really goes with what I was saying before about this idea when I looked at that data of what happens if we're wrong about prices, and I was talking about before I went on vacation. I pulled up actual quotes from our market makers of where we could buy cap programs I was looking at the 4th quarter of this year. Say somebody says, I want a 3-month deal for the rest of the year on diesel. On September 23rd, If you wanted to buy an at-the-money call option covering each month for the remainder of the quarter, on September 23rd, believe it or not, that number was $2.25 a gallon on average for the last 3 months of the year. And you could have bought upside protection, a call option, for 9.5 cents a gallon per month over the course of that quarter. Obviously, the market has roared higher by 25 cents a gallon. So if somebody did that on September 23rd, you'd have a very happy client right now. But my point wasn't to say, this is great and we're very smart about knowing where the market's going. If the market had dropped 25 cents a gallon, your customer would also be thrilled because they wouldn't be locked in at 225. They'd be protected at 225, but they could still be buying at a lower price at $2 or 190 or wherever the market would go in that unexpected bearish situation. So these are things that you're changing that dynamic. You're not just talking about price only, you're talking about solving the customer's problem of, did I buy at the wrong time? That's almost just as valuable as what price did I pay, as we've seen over the last couple of weeks. Clearly, if you bought 2 weeks ago, you're very happy. One variation, and the second sentence on this slide, is many customers look and say, well, maybe I'll fix half the gallons and then do a cap on the other half. That way I'm cutting down the cost of the premium that I'm spending, and I'm still getting, a fair degree amount of flexibility. You can work with customers. This starts, again, to change the dynamic entirely. You can have a very different conversation with your customers about their fuel spend and how they're going to try and protect this. And you're getting away from simply competing on price and price alone. And that gives you a different dynamic and helps you be different than many of your competitors. The last thing that I wanted to talk about was taking what the market is giving you. And this is the picture you're looking at right now is what we call the futures curve. As many of you know, there are many futures contracts that go out month and month and month out into the future, and they all trade at their own independent price. They do tend to move in tandem, but not always equal. And many times you can have certain prices in different months be drastically different. This is the futures curve for diesel as of September 23rd. And the front month is much higher than some of the more distant months. As you can see, the front month was roughly $2.25 a gallon over here on this part of the chart. And as you go out in the future, the price for diesel is actually less on the traded futures market. Why this happens is obviously because the market is in a very bullish mode. People are worried about getting supply now. They know the refiners can crank it up in the future. They know the producers can crank it up in the future. But right now, demand is outstripping supply, and so people are competing by offering higher bids to secure their fuel. What does this do for a marketer? When we talk about how does this drive sales? Well, as you can see, if you're looking on this chart, you have a couple of different ways you can use this. You can say, I can supply you at roughly $2.25 a gallon for a spot deal. But if you know how to hedge and you can utilize a hedging strategy of buying a strip of futures contracts, you could offer a 6-month deal. Again, this is back on September 23rd. You could have offered a 6-month deal at roughly $221.5. You could offer a year deal at $217.5. 18 months might be a little bit long, but you could do that at $215 if you'd want. In other words, by buying these lower priced months out in the future, you can lower the cost of the whole deal. You also have the added benefit of locking your customer in for that period of time. They're going to be sticking with you on this fixed price deal because they've been able to get this 3.5 or 8 cent a gallon advantage depending on how far they go out. You can do it on a 3-month deal as well too. So all these are tactics to take what the market's giving you. When the market's in backwardation, it is a marketer's dream because you can sell term deals at lower prices than spot deals. The customer gets a better price, you get more gallons. They're locked into you to get that gallon advantage. A guy who owns a storage tank doesn't like this market because he's not getting paid anything to store oil in his tank. But for marketers, and some of you may have storage as well, you can learn this to offset the times when you don't have the storage play, when you don't have that carry trade on utilizing your tanks. This is a great thing to go out and aggressively, go after your prospects and your customers and say, hey, we can give you a better price and take advantage of this futures curve if you'll, buy 6 months worth of fuel from us. So another way to look at taking what the market's giving you to your advantage. Now, some of you might say, well, hold on, I don't know what any of this futures curve stuff is. Are people really doing this? Here's what we look at every day on our screens is who's trading and where are they trading. These are all the months for diesel, October 21 out through 22, even into 23. Every day these numbers are changing. The last trade, how much the change in the day is, the bid and the ask. A couple of things just for people who are trading, geeks like myself. Look at the liquidity and the difference between the bid and ask on the futures markets. Even going out, as far as December 22, your bid ask is maybe 30 ticks, going out that far in the future. There's some gaps. Sometimes there's a wider bid ask, but in the liquid months, very tight bid asks all the way through. And look at how many people are trading this. Hundreds of thousands of contracts of open interest. Even going out, as we were saying, well into 2022, you've got thousands of contracts of open interest. Liquid trading all throughout the day. Tens of thousands of contracts being traded in and out. So clearly there are a lot of people doing this. There are a lot of people looking and saying, hey, I want to secure some diesel fuel out in the second quarter of 2022. And so, people are doing it. You ought to be doing it too if it's what your customer wants. And in a backwardated market, you're in that position to utilize it to your advantage by being able to offer a lower price than the spot deal. Again, you're signing a contract with the customer. These are deals where they're buying that fixed price deal based on where you can lock in on a futures contract. The advantage on financial hedging is many times the physical supplier won't give you that deal when we looked at those differences of 3 or 4 cents or 5 or 6 cents better than the spot price. If you say, hey, I'd like a 9-month deal from a physical supplier, I would challenge you to see if you could find a price as good as you can get using the futures market yourself. And that's just the nature of, you're asking your supplier to take on an obligation for a longer period of time. They're going to build that into their cost. You can learn to do it yourself. That's why I was talking about building your intellectual arsenal, your strategy and tactics arsenal, and having that at your disposal when the market gives it to you. In times when there's market carry, that's not a tactic that will be effective, but you're flexible. You can exist and adapt and succeed in any of these market conditions. And you can find ways to bring things to your customers that solve their problems. What are they really worried about? Is it exactly that half a cent a gallon of getting the best price? Or are they terrified that should they buy now? They wait a week, oh gosh, it's even worse for me. I should have bought last week. What do I do now? Those are the problems you're now solving. You're not worrying about the half a cent difference anymore. And that's a critical differentiator. The biggest thing I wanted to leave with you is what we know. Well, petroleum prices are volatile. Use what the market gives you to your advantage. Remember, your clients, nobody likes dealing with expensive uncertainty, and that's what we have when we're facing our decisions on fuel pricing for significant inventory buys. Customers like to have a sleep at night price. They don't want to have to revisit this. Many times if you're dealing with a fleet, certainly any type of municipality customer, they don't do this every day. They don't do this every week. They may not even do it every month. They may buy seasonal deals. These are not things they want to come back and revisit. So find a way to give them something that helps them sleep at night. Looking at ways to market for heating oil dealers. The same thing. They come and look at price it seasonally one time. Find ways to help them market more effectively and be better customers for you. And lastly, you're using these tools to help put yourself on the same side of the table and keep your customers, so you're not spending time going and getting new customers and replacing the ones you've lost. When you're working with them as an ally, as somebody who's solving those problems, then you're building a deeper relationship with them that isn't just on price alone. And that, I think, is one of the most powerful dynamics you can use in your marketing. Again, these are all tools that are linked to customer deals. So we're not talking about taking a flyer on the market direction. We're talking about utilizing a hedging tool to solve a customer problem and grow your business. So with that, any questions, I'd be happy to answer them, or we can go back to any questions from Jed.
David, thank you so much. Appreciate you sharing those tools that we can consider. So question, if our objective is to grow our sales, what is the simplest, most effective tool that you would recommend we focus on if we just had to pick one?
If I just had to pick one, I would always go with this idea of when you talk to a customer and he says, hey, what's the price? I would price them, and this works best probably for commercial customers, is to say, here's our fixed price, but we can also do a cap price at this level. And don't talk about the price of the option so much as talking about what problem you're solving. To say, here's our fixed price, but gosh, if you're worried about the market falling apart after this huge bull run we've been on, we can solve that problem for you too. And lead in with that. So there you have sort of the A and the B. And coming at them, customers like having choices. They don't like having to say, wow, okay, you might be showing me the best price, but I have to buy it right now, and I have to decide that I want to lock in and own it. And I'm terrified that after a run up of 25 cents in 2 weeks, it's going to fall apart 15 cents right after I sign on the dotted line. So I would probably say that idea to come out with your fixed price and a downside insurance price as well is a very powerful tool. And as I said, the 9.5 cents a gallon for the fourth quarter, again, we just saw a 25-cent move in 2 weeks. It happens all the time. It sounds like a lot, and I certainly understand that, especially in commercial fuel, but we've had commercial customers who do this because they look and say, I can't afford to buy that amount of fuel and have it fall apart 20 cents in my face because I can't sell it that fast.
All right. Thank you, David. I like that concept of, we use hedging to help ourselves sleep better at night. How can we use hedging, putting ourselves in our customers' shoes, to help them sleep better at night too? And that's an important thing for us all to remember. And I just wanted to ask you before we wrap up here, any closing thoughts on your end as it relates to credit, or something that came to mind you may wanted to emphasize?
Well, Jed, I always like to say that, petroleum companies are a perfect storm for low margin, high volume, sales oriented, businesses. So keep being diligent about making those good decisions. It takes a lot of loads to make up for one lost load.
That's a good point. Well, thank you, David. Thank you, Ann. I appreciate your time. We'll make these slides available to you, the members. I appreciate you sitting in. I hope you found this to be educational and valuable. Have a good day, everybody. Goodbye.
Bye. Thanks.
Bye-bye. Thank you.